This is your technical update from the LMAX Exchange Research and Analytics Desk for Thursday, March 24th, 2016. Euro dollar. So the euro has come back under pressure in recent trade after gains stalled out ahead of the 2016 peak from February at 113.77. There's a lot of good medium-term resistance between the 114 to 115 area, and so it's not surprising to see the market pull back again, potentially in favor of a resumption of this broader downtrend. But it's going to take a break back below previous support at 110.58 to really put the pressure back on the downside, and until then we can't rule out the possibility of some form of a higher low and fresh upside back towards and eventually above that 1377 2016 high. Sterling dollar. So cable is back under pressure after this market stalled out into recent rallies off those 7-year lows at 38.36. The market is now coming into key support at 140.53, and a break and close below that level on Thursday would do a good job of opening the door for a full retracement back towards that 7-year low, going back to February 29th at 138.36. A break below 138.36 would then expose the multi-year base at 135 further down. At this point, it's going to take a break back above 146.68, the high that we saw back on the 4th of February, to take the immediate pressure off the downside. Dollar yen. So although we've seen a bit of a bounce in recent trade in dollar yen out from those recent 110.67 multi-month lows and 2016 low, overall the pressure continues to remain on the downside in this market while it holds below some medium-term resistance around the 115 area. It's going to take a break back above 115 to take the pressure off the downside, and until then rallies are classified as corrective in favor of what could be the next lower top and a bearish resumption back below 110.67. Euro Swiss. So Euro Swiss hasn't done much over the past few months with the market largely consolidating, but overall the recovery structure remains intact here, with the market eventually favored to break higher above the recent multi-month high at 112 and towards 115 further up. At this point, setbacks should be very well supported towards 108, with only a break back below 107.15 to compromise the constructive outlook for Euro Swiss. Aussie dollar. So a bit of a turn of events for the Australian dollar, an impressive rally in recent trade, taking out previous resistance at 73.85, went all the way back up towards 76.81. That's the 2016 high from the previous week, before the market finally stalled out and reversed course. At this point, there is a possibility for the formation now of a lower top ahead of a bearish resumption, but it's going to take a break back below that previous resistance, now turned support at 73.85, to officially put the pressure back on the downside. Dollar CAD. So dollar CAD had seen an impressive pullback from the near 13-year peak in January at 146.90, with setbacks extending more than 10% all the way down towards and just shy of the October 2015 base at 128.32 ahead of this latest minor rebound. At this point, the rebound is starting to gain momentum, and we could see gains now extend back towards and above 134. Key resistance comes in at 134.06, and if we see a break above there, it really could do a good job of establishing the next form of a meaningful base or a higher low, a medium-term higher low, in favor of a resumption of the broader underlying uptrend. Kiwi dollar. So Kiwi setbacks continue to accelerate, with the market now approaching next critical support in the form of 65.46, that low that we saw going back to the 16th of February. Below there would then expose that medium-term support at 63.47 further down. That's the low that we saw all the way back on the 20th of January, which also happens to be the 2016 low. At this point, any rally should continue to be very well capped towards 69, with only a break back above that 69 handle to compromise the bearish outlook. SPX 500. So the S&P 500 is now stalling out in this ideal lower top zone that we've isolated, with the market unable to establish above 2050 and rolling back over. At this point, deeper setbacks are favored. A medium-term lower top is favored ahead of the next downside extension to eventually retest those recent multi-month lows at 1808, below which will open the next downside extension and measured move objective into the 1550 area. At this point, only a weekly close back above 2050 would compromise the newly adopted bearish outlook for the S&P 500. Gold. So gold has seen some sharp declines in recent trade, with the market pulling back from highs that we saw 2016 highs all the way up towards and above 1280, now pulling back towards 1200. But previous resistance now turns support at around 1190 should act as a formidable support zone in favor of what is now a shifted structure that looks to trade back towards the top side. The break above that previous resistance at 1191 was a significant medium-term development for this market, and as such, any setbacks from now to the 1191 area should be very well supported ahead of the next major upside extension, eventually towards a retest of the 2015 high from January 2015 at 1307. Only a close back on a weekly basis below 1190 would compromise this newly adopted bullish outlook for gold.